Hey everybody, it's Ken Perry with Broker Knowledge Group. So normally I do the whole editing thing and I give you a really clean video and we've added some music. But today we're going down and dirty right off the iMac because there was some breaking news that just came out of the House Financial Services Committee over in DC. So they had this huge event today, big meeting. They invited everybody from the Fed to the HUD to the CFPB to NAM to NAIHP. I mean, they invited everybody. And everybody got to testify. The big breaking news that we got out of it came from the Fed. So the Fed and the whole compensation thing has driven us crazy. And the one thing I think that we can all agree on is the biggest problem with the Fed compensation was that a mortgage broker who receives money directly from the consumer cannot turn around and pay their originator for having done that loan. Well, check this out. The Fed today, and I'll give you her name, it is the Honorable Sandra F. Bronstein, testified. And I want to read you what she said so that you're getting it directly from her because it kind of shocked me, and I imagine it's most likely going to shock you as well. It's not consistent with anything that they've written. It's not consistent with anything they've said in the past, but here goes. She talks about consumer-paid transactions, how consumer-paid transactions have been so that the broker can't pay their originator. Then she says, and I'm going to quote this directly for you, one consequence of this prohibition is that in consumer-paid transactions, a mortgage broker firm that is paid directly by the consumer may not pay a commission specific to that transaction to a loan officer. Because the restriction only covers payments that are specific to the particular transaction, a brokerage firm that is paid by the consumer directly can still provide its loan officers with incentive compensation, in parentheses, in addition to salaries or hourly wages without violating the rule. So this is brand new. Not sure where she's getting it. I don't know if this is new interpretation or what the deal is, but you're going to hear over the next few days, everybody's going to get this information, process it, see what it means for them. But it sounds like they're changing their tune so that the broker can actually start paying their loan officers even if the borrower has paid directly. So there's your breaking news. Now let me just break down a few things that I was shocked by also from this same meeting. As I mentioned, everybody was invited. So HUD was there. The lady from HUD was super nice. She talked about RESPA. But then all the other regulators who were discussing RESPA, as well as all the people from Congress, or the majority of them who were in the room, said they are hearing that nobody actually understands that good faith estimate. And they're right. In fact, the American Land Title Association had somebody on the panel. The American Land Title Association is one of my favorite associations because they are just dynamite as far as information goes. They always kind of know what they're talking about. And so they delivered just a ton of testimony about how troubling it is for a borrower to walk in and get a loan and understand the fees. So everybody was bashing on the good faith estimate and the HUD won. One really cool thing came out. One of the representatives really got the American Land Title Association lady and said, what exactly is confusing? And she said, well, specifically, let's take owner's title. Owner's title is not paid by the borrower, yet we have to disclose it. And the representative said, wait a second, so you have to leave it blank or what? And she goes, no, we have to disclose it as if they're paying it. And the guy was like, I can't believe, I mean, I'm paraphrasing, but he could not believe that it would be that confusing for a borrower. So kind of amazing that a lot of people don't know what's happened as far as the confusion goes with the new good faith, but everybody's starting to look at it like we've got a huge problem. So expect the CFPB to come out with a new good faith estimate, and they've already shown us some samples of it, but you can expect that to come out pretty quickly just because it seems like all the regulators are saying the same thing. Even HUD, the lady from HUD on this call or on this in this hearing, even the lady from HUD said, our GFE was a great start, and we look forward to joining the CFPB to create a brand new one that really completes that process. So even the lady from HUD was all about the old good faith isn't necessarily the be-all to end-all and that we're going to see something new. So that was kind of a general theme of it. The other theme that came out, a couple others, obviously the appraisal issues are coming out now because the appraisal timelines are coming up. And so there was a lot of talk about the appraisers not getting paid anything to do their work. Mark Savitt actually dealt with this from the NAIHP and did an amazing job explaining that appraisers are just not getting compensated. It's really become now this big bank entity. The broker appraisals are, ordered through this third party. It's really not working out. The banks control valuation. It's one of the things he said that I really liked is banks then control valuation within America. They're the only ones who can order the appraisals. So appraisals came up big. Then finally qualified mortgage and qualified residential mortgage. Those guys came up really big. And everybody's discussing whether or not 20% down is too much. I thought it was fascinating that the Fed came out and they're one of the ones who actually defined qualified residential mortgage, and they're continuing to define it. And they came out and said what we wanted is, and I'll give you a quote here, they said we wanted QRM to be a narrow slice. So that would be a narrow slice of the mortgage industry, and then there would be all these other loans that were done. And everybody hammered on that. They were like, great, where's this other market? Where's this other market? It became clear the more that people talked about it that there is no other market. When you limit your qualified residential mortgages and when you're not giving us a good enough safe harbor to be able to do loans, you're going to eliminate most of the loan programs out there. So this was step one of them trying to get, back to a way where we're doing smart loans and we're increasing the availability of credit instead of decreasing it by over-regulating. So I was really happy with this call. The only thing that blew me away was when Mike Anderson of the National Association of Mortgage Brokers actually said that when he, during the boom times of the business, he'd go and throw back a beer with his buddies after work and talk about, I can't believe Fannie Mae just approved that 65% debt to income ratio. Then he went on to say that everybody in the industry kind of knew this day would come. So that may have harmed us a little bit, but he did a great job in the end. He answered his questions pretty well near the end of the session. That was the only one that I was like, oh, geez. So we probably won't pay for that one too much, but it wasn't the greatest. So anyway, that's a lot of information. I'm going to continue to process. I've got, 6 pages of notes of what I took from it. So I'll continue to process it, probably bring some up for you next Wednesday. That's your Wednesday update. Have a great day. We'll talk to you guys next week. Remember, we're available at brokerknowledge.com. And if we're not training your people, you definitely need to give us a call because we can